Yes, everyone, welcome to the next lesson. So in these next two lessons, we're going to be looking at the different types of interest rate environments. And in particular, for this one, we'll be looking at the low interest rate environment. So to truly and break this down, we can simply dissect it in all these different steps. And of course, refer back to the market cycle video that we looked at previously, because it will, just tie in perfectly with that. So at the moment, what we're seeing across the world is interest rates are particularly low, especially near 0%. What this usually means is we're usually in a state of financial crisis or a recession. Now, governments want economic growth. Therefore, low interest rates encourage more borrowing for consumers. In terms of fiscal policies, of course, we've looked at monetary policies, but for fiscal policies, that could entail lower tax rates. Higher amount of asset purchases are also used to increase money supply. And then what this means is that inflation starts rising with high levels of economic activity and money supply. Well, with all of this going on, we hope that there will be higher levels of economic activity. And that's what the countries who obviously go through the QE program better off than other economies, that's what we're going to be comparing. In terms of investments around the world, they tend to be directed toward the equity investment market, such as stocks, since treasury bond investments bring little return uh, on investment due to the low interest rates. In terms of the bond market, you've particularly got to look at the yield as well, understanding the prices of the bonds at the time. And in the third section of the fundamental course, we're going to be looking at bond market in more detail, so definitely keep this in the back of your mind. Now, what tends to happen, just to break this down fully, we've got higher inflation that's shown through the CPI data and the PPI data. Of course, that's consumer price index and producer price index. Then you get the currency that devalues. Bonds are less attractive due to the low interest, so lower return on investment. The equity market is more attractive. So what we mean by this is stocks. And more recently, there's been a lot of institutional interest through into the crypto market. And then obviously that leads to more spending and investment around the economy, increased spending rather than saving in banks. Now that's I want to keep it short and sweet for this lesson, and obviously the next lesson. But guys, just take notes, understand this fully, especially in relation to the market cycle. Anyways, take care and I'll see you in the next video.